let's take a look at what happens if you pay after the discount period. So remember, this is going to cause an adjustment for us if we recorded under the net method. So remember, under the net method, we assumed that we were going to take the discount. So we recorded it at the bare minimum amount, right? So now we realize we actually owe the entire amount. Since we lost that discount, right? We lost the ability to take that discount. We're going to use a new temporary account called discount lost. This account actually ends up in your selling, general, and administrative expenses on your income statement. It is a temporary account. We will close it just like we close any other expense type account. Okay. What it's going to do is it basically is an expense. It's going to lower your net income, which lowers your retained earnings. This is why some investors are interested in these discount lost accounts, because you can tell, why are we forgoing the ability to pay cheaper prices for these products, right? What's going on? Is there a larger problem happening in the background that we've got to investigate? Okay, so what we've done is we've lost this discount, right? We had we recorded our accounts payable at $400 times 98%, which is the purchase less the discount, right? They offered a 2% discount, so we're only going to be paying 98% of that purchase price. Remember, it's $400 because we returned $100, or we were given an allowance for $100 worth of the glue because they sent us the wrong kind of glue. Okay, so we recorded accounts payable at only $392. So we said we only owe $392. That's all that's available for us to decrease the accounts payable account by. So we do that. We decrease the accounts payable by $392. However, what we actually end up paying is $400 in cash because we owe the full amount due now because we missed the discount period. Okay, what happens to that other $8? Well, it goes to that temporary discounts lost account. That means we can look at this and say, hey, we had an opportunity to pay $8 less for this material, and we had to end up paying the full price because we didn't meet the terms of the discount. Okay, and an investor may ask why. A manager may be asking why. A purchase manager may be asking why are we missing discount terms. Okay, but just remember, we're going to record these. In the net method, we have to make the adjustment, and we record that adjustment in the discounts lost temporary account, which is really just an other type of expense. Okay. Under the gross method, we're going to recall that we assumed that we were not going to take the discount anyways. So we really don't have to make an adjustment here because we've already made the assumption we're not taking the discount. So if we don't take the discount, no big deal. We just decrease our accounts payable and pay the cash we owe. It just so happens that we're paying the maximum amount, right? The full purchase price, okay? So gross method, pretty easy, pretty simple when you don't take the discount because we've already recorded it as though we're not taking the discount, right? So what you'll notice is that either way, at some point you'll be making an adjustment, whether you miss the payment period or you don't miss the payment period. Okay. So the next thing we got to talk about is how do we adjust the ending inventory after the count using a perpetual method. So if you recall, we said that even with the perpetual method, even with a system that is tracking your inventory for you, you still need to go in and do a physical count at the end of the period. There are several reasons why you need to do this. The one that always jumps to the forefront of my mind is because you have leakage, right? You've got people that are stealing product from your store. People go into Walmart, Target, Hy-Vee, wherever, and they steal things every day. Okay, that's why these places employ loss prevention experts. That walk around and follow you around. They watch the cameras to see who looks suspicious, that kind of thing, right? But there's other reasons why your inventory, your ending inventory from physical count may not match the ending inventory from your perpetual tracking system. You may have coded something in incorrectly, right? So when somebody's scanning it through, it's not reducing the correct inventory account. Okay, you may have lost something. Something may have fallen behind a shelf. Something may have been broken, right? Now, if it's broken when you receive it from shipment, you're going to send that back, right? That's going to be one of those return transactions. However, maybe you've got somebody stocking candles on the shelves at Walmart and they drop 2 or 3 candles and they break, okay? Then your ending inventory is not going to match what your system says it should. So there are a lot of reasons why you need to go back and make an actual physical count of your inventory, okay? So let's assume that the inventory system tells us that there's currently $52,000 in the ending inventory account. We go into the back, we go to the shelves, and we make a count, and there's actually only $50,000 worth of inventory on hand. Now, I will remind you, this on hand, that's your ending balance, right? Remaining on hand, those two things, they mean ending balance. So what we're going to have to do here is we're going to have to reduce that inventory asset, right? If we don't have it to sell, we can't count it as inventory, so we have to reduce the inventory asset. How do we do that? We do that with a credit, okay? So we're also going to have this new loss type, okay? It's a different type of expense. It's a nominal account. It's going to end up on your income statement, right? It's probably going to end up in your SG&A section. And your non-operating, it may end up in, well, it's definitely going to end up in your operating section because a loss of inventory is a loss in your operations, right? So typically it's going to end up in your SG&A section. We call this account loss on inventory, and it is simply the difference between what our inventory system says we have and what our physical count says we have. Okay. Notice we are debiting this. It is like an expense, right? We are debiting it to increase it. A loss is just a different type of expense, and they are nominal accounts, meaning this will close to retained earnings at the end of the period. Okay. So finally, the last thing we have to talk about for Chapter 8 is what we call the COGS model, what I like to call the COGS model, your cost of goods sold model. Okay, it's not really a formula, it really is a model, right? We're plugging in the things we know, and we're trying to see what the relationships are between these items, okay? So yes, you can think of it like a formula, but really it's a model, okay? And I would treat it as such when you were trying to solve problems using the COGS model. If you were being asked what your ending inventory is, if you were being asked what your cost of goods sold is, if you're being asked what your beginning inventory is, right? What were your purchases during the year? You can get to all of those items using the numbers that you know. Just plug them into the model and it will spit out an answer for you, okay? So the way this works is your beginning inventory plus any purchases you make equals your cost of goods available for sale. So for in this instance, they had $20,000 in beginning inventory. They had $90,000 in purchases during the year, totaling $110,000 worth of inventory that was sitting on their shelves available for sale during that period. Okay, so you take that cost of goods available for sale and you reduce it by all of the inventory that you sold. That's your cost of goods sold, right? So cost of goods available for sale less cost of goods sold equals your ending inventory. Okay. So in this instance, they sold $80,000 worth of these $110,000, leaving them with $30,000 in the ending inventory. Recall, this cost of goods sold, it goes to your income statement, right? It is an expense. The ending inventory goes to your balance sheet. This is your asset, okay? When we get to a later chapter, we'll talk about LIFO and FIFO and how different valuations affect your inventory asset, how they affect your cost of goods sold expense. Don't worry too much about those right now. We will see the impact of those, but you will need to use the COGS model when we talk about LIFO and FIFO valuation methods. This is just a kind of a slide to show you, hey, look, we can rearrange this model to give us what we want. Think of it like a formula, you can rearrange it, right? Cost of goods available for sale less your ending inventory equals cost of goods sold is essentially the same thing as saying your cost of goods available for sale less your cost of goods sold equals your ending inventory, okay? So again, this is like a plug and chug problem, right? Plug in the numbers you know, chug for the one you don't. Try to get to that answer, okay? So this is what your periodic method example for your COGS model would look like. You start with $35,000 in your beginning inventory. You have $650,000 worth of purchases during the year. You have returns, allowances, and discounts totaling $18,000. So you just put it into the first two parts of that COGS model, this right here, to get our cost of goods available for sale. So we take our beginning inventory, that $35,000. We add our purchases less our returns, discounts, and allowances, right? These reduce the value of our purchases, so we're going to reduce it by that. We're going to net our purchases, essentially. That gives us $632,000 in net purchases throughout the period, which gives us a cost of goods available for sale of $667,000. Okay? They provide us a little information. They said, hey, we did a physical count of our inventory. There's $30,000 of inventory on hand at the end of the month. On hand, once again, means ending balance. Okay? So now we're going to take our beginning inventory. We added our purchases, our net purchases. We get our cost of goods available for sale. Now we can reduce that by our ending inventory, and we can see that our cost of goods sold, what it cost us to sell, our expense, was $637. Recall, this ending inventory goes to your balance sheet. It is your asset, and your cost goes to your income statement. It is your expense. Okay, so that is Chapter 8. If you have any questions, please contact me, and I will do my best to walk you through it. Thanks.